And now we've seen if you add of course restructured assets, that is if you take stress loans, we know that the latest response which Reuters has got to Right to Information Act set of questions is basically suggesting that we have something like 9.5, 9.6 lakh crores of stressed assets, which amounts to about 12.8% of total gross advances. So you basically have a V-shaped curve in which, starting with the post-Narasimhan Committee reorganization of the asset position of the banking system through recapitalization and other means, which reduced the gross non-performing assets to gross advances ratio from something like 12.8 or 13% to about 2.5%, we actually have seen a return from 2.5% to about 12.8%. So therefore, we are actually seeing a transformation which has occurred within the period of liberalization, in which a banking system which ostensibly through the process of liberalization and the restructuring which that was going to be involved, a changed relationship between the regulator, which was the Reserve Bank of India or the central bank, and the banking system. You were supposed to have got it into a position where it was going to overcome what was seen in the Narasimhan Committee report, which ignored all the great achievements of the nationalization era, but which actually saw the existence of non-performing assets attributed in large measure to priority sector credit and small borrowers, attributing that to be the principal problem faced by the banking system, to go through a process of reorganization or restructuring in which we wanted to focus on reduction of non-performing assets and give freedom to the public banking system, still public, let us be clear about it, give greater freedom to the public banking system such that you end up with a situation where once you've restructured or cleaned the books of the banks, there would be a process in which there would be a new credit era, as it were, in the Indian system, in which public banks would begin to fund in a different way, more efficiently, with more options for the clients, fund the process of growth, fund the process of partly of inclusion, and so on and so forth. So the issue is that if that was the original intention, and it appeared from that curve, that V-shaped curve, that they were somehow managed to a certain extent achieve that goal in the period from 1991 or 1992 to the early 2000s, what really happened? Why suddenly did we see this transition which occurred within the liberalization era itself? Now, if you look at the proximate causes, we know, all of us know what the proximate causes are. The proximate cause was that during a period of high growth, of extremely high GDP growth, we actually saw a simultaneous increase, a sharp, radical increase in the ratio of scheduled commercial bank lending to GDP from something like 20 to 22% of GDP in the early 2000s to something like 55, 56, perhaps now 60% of GDP. A transition which actually meant that you had moved from a situation of relative stability in the credit to GDP ratio, which is the scheduled commercial bank credit to GDP ratio, to a situation in which you had a sharp increase in the credit to GDP ratio, which is almost, close to a trebling of that ratio. Now, there are two things which we should keep in mind here. First, of course, even if we say 60%, it didn't even touch 60%, I think, but even if we say 60% by international standards is not an alarming credit to GDP ratio. We are talking about credit to GDP ratios which can be more than 100%. We are talking about household debt to household disposable income ratios which were 160% in the United States before the crisis, which last year was 160% in South Korea when there was a household debt crisis in South Korea. So 60% per se is not something which is very alarming, but intertemporally speaking, compared to what we prevailed in the banking system, this was a significant increase that had occurred. The second point we should note is that in this relationship between the expansion of the credit GDP ratio and the rapid rate of growth or the movement of the Indian economy to what was claimed to be a high growth trajectory, which of course we now have got off, the issue was, which way does the causation flow? Was it that credit was booming because the economy was booming, or did the economy boom because credit boomed? And we know that if you actually begin to examine other countries which went through long phases of liberalization, starting of course with the home new banking, of the new financially liberalized efficient market model, which was the United States of America, we know that liberalization leads to a credit boom, and a credit boom in fact provides the bubble on the basis of which growth occurs. So perhaps what we are actually looking at is a situation in which the growth that we got during that period was actually a growth which came because of the rapid expansion of credit, and that rapid expansion of credit obviously was providing the credit bubble on the basis of which the Indian economy seemed to have got onto this high growth trajectory. The problem really was that when this happened, as has happened in many other contexts, it happened in Japan, it's happened in the United States, it happened in Europe, we actually are in a world in which we end up with a situation where at some point of time this becomes unsustainable. When it becomes unsustainable, non-performing assets, as we call them here, others call them, toxic assets, bad debts, whatever you may call it, end up accumulating to an extent where it becomes difficult for the banking system to lend and for the public at large in terms of the corporates and households to borrow because of the burden of past debt, and therefore you are unable to sustain this process of growth. So if this way of interpreting the challenge which faces banking today is right, then what we are really talking about is not a challenge to Indian banking per se. We are actually looking at a challenge to the growth of the Indian economy, to restoring what people thought was taken for granted and which Modi and company thought that they'll take even further. So which is why there's almost panic. I mean, when it began to happen, there wasn't even clarity in the government. They weren't even willing to accept that growth was slowing down. There was no clarity on why this growth was slowing down. And even now there's a sense of panic. Till just couple of weeks back, they weren't even willing to accept the possibility that what those numbers, even though being doctored, were pointing to was a significant slowdown which was occurring in the Indian economy. So therefore, if we look at the picture in this fashion, obviously the next question which arises is, so then what explains this significant increase in the ratio of advances to GDP, which of course later became a problem in terms of an increase in the ratio of stressed assets to advances. Now, one way of approaching that problem is to ask, where did the credit go? And we know, I mean, this has been discussed much, we know that broadly speaking, there have been two areas into which it has gone. It has gone in substantial measure. Even it is true that even agriculture got an increase in credit in the period after 2002-03. I mean, people like Pallavi Chauhan and Ram Kumar and so on have pointed to the fact that if you look at the post-liberalization era, there was a period in which it appeared as if agricultural credit and priority sector credit was coming down, and then you actually began to see rural credit going up. So it was not that rural credit didn't go up, but what we had was a focus in increase in lending in the aggregate statistics, which pointed to an increase in lending to industry. Not that the share of industry went up, it in fact came down slightly from about 50% to about 47% or 46% of total advances, but that was occurring in a period in which you had a near trebling of the credit to GDP ratio, which means that the actual volume of lending to industry from a very high base was rising, and within industry we know something like 3% of total industrial credit which went to the infrastructural sector, something like 35% of total industrial credit now goes to the infrastructural sector or to big projects, including of course projects in steel besides power, ports, roads, civil aviation, etc. So one area into which, so if you approach the issue from the point of view, where did the credit go? One area in which it went, which was a big area, was of course to industry and infrastructure, and the other area we know is that it went to the broad area of retail lending. It went to personal loans of various kinds, automobiles, housing in particular, educational loans, credit card receivables, etc., etc. And if we look at the distribution of non-performing assets, it's now very clear that it's not so much as of now retail lending which is delivering for us in substantial measure, even though the RBI had issued warnings about this earlier. It's not so much retail lending which accounts for a significant share of non-performing assets, but it is that lending which went at the margin to sustain this kind of high level of investment in the industrial sector in keeping with the debt-financed boom in private investment spending and private consumption spending. But this is really asking the question, where did the credit go? But why did this happen? Is it just that bankers went crazy suddenly and they started lending left and right and they said, who's only willing to borrow big amounts of money? And infrastructure said, yes, we'd like to borrow, and they gave them the money. There must be some logic to this system. What is the mechanism within a liberalized banking system which pushes credit in these directions? Now, one way of interpreting it is to say that first there must have been a push factor, pushing for this near trebling of the scheduled commercial bank credit advances to the GDP ratio. And the push factor has to be essentially a substantial increase in liquidity in the system. Because if there is increase in liquidity in the system, where does it go and settle? It goes and settles in the first instance as deposits to the banking system. If the banks gives credit, where does it go and settle? It goes back into the banking system. That's how you have the credit multiplier operate within the banking system as a whole. So what was the push factor generating this huge increase in liquidity? Now, if you look at what could account for this push, there seems to be one variable which dominates over all others, and that variable is the substantial autonomous injection of liquidity through foreign investors into the system. And this makes sense in terms of the 2002-2003 break, because if you look at the figures on foreign investment flow into India, it is true that post-liberalization foreign investment flows went up from a few hundred million a year to about 4 billion, 5 billion, 6 billion. But if you take the period after 2002-03, from about $6 to $7 billion or $8 billion, it goes up first to 20, then it goes up to 40. Now it's running at about $60 or $80 billion a year, if you add both what's called FDI today and foreign institutional investment. Now, if you have a large amount of liquidity coming into the system in the form of foreign investment, what do those foreign investors do? They actually come, buy assets of one kind or another. They employ people, they go to the stock market, buy equity, they go to the debt market, they buy debt assets, etc. And to do that, they have to convert their foreign exchange into rupees. When they convert their foreign exchange into rupees, they're injecting liquidity into the system. And when liquidity goes and settles in the books of the banks, a banker has no choice. If a banker is faced with an increase in debt on the deposit side, you have to increase on the lending side, because otherwise, as a bank, you'll be making losses. You're paying depositors an interest, and if you're not getting a return, how could you survive? So there was a fundamental push factor created by the ethos of liberalization, which was actually driving the system to a situation in which, once that transition occurred in the early 2000s, you were going to have an increase in the ratio of aggregate credit to GDP. Now, what influenced where this credit went? One way you can say is that, listen, okay, if I'm willy-nilly forced to find lenders, I go and look for new lenders. And an area in which at least there was government support for borrowing was in the area of infrastructural investment, because the government had basically said, I don't have the money to make these investments. I don't want a development financing section to continue to exist, because that's not a level playing field for a liberalized banking system. I really want to actually to help private investors undertake this investment. And one way we can help private investors undertake this investment is to give them credit, allow them to have high gearing ratios, allow them to borrow substantial measures. And if it is the same set of investors who are investing in multiple projects, then you shouldn't look at how much a person has borrowed from one project when you're lending for the other project. You basically say, you look at each project by itself, and if you think that you should lend, you tend to a certain extent to lend. But obviously, this whole process was encouraged by the fact that the ethos of public banking was being transformed by liberalization itself. Just because a bank is a public bank doesn't mean it remains the same in the period of 1969 to 1991 and in the period from 1991 to today. That public bank tends to be different from this public bank. Let us not forget that it was one chairman and managing director of the State Bank of India who, a few months before he retired, decided to take on the Reserve Bank of India and say, why do we have to have a cash reserve ratio? Well, some of us were taught in the textbooks that the reason you need cash reserve ratio and deposits with the central bank and certain kinds of capital assets is because of the fact that if there is a sudden demand from your depositors, you must have somewhere to turn to. You need some reserves. So you need to keep this money. So he says, why? It should be zero. In an environment in which already the CRR has come down hugely, where already SLR is come down hugely, there is a chairman of a public bank. So obviously that chairman of a public bank is not the same as a chairman of a public bank who lived in, let us say, the 1970s or the 1980s. So we should not be under the impression that public banking per se does not change. Public banking in China today, I think, is very different from public banking in the mono banking system which China had at one point of time. So therefore, there was a certain degree of flexibility, and the sort of benchmark of what constitutes success in public banking began to change. This began to change the ethos at the top of the public banking system itself. And you wanted to use that flexibility in a context in which there was a substantial increase in liquidity to try and lend. And infrastructure was a good area, because not only was it an area which demanded a lot of money, there seemed to be an implicit sovereign guarantee of the Indian government, because the Indian government was pushing infrastructural investment. So the banks, public banks, hardly thought that a government which wants them to lend, which is very happy if they lend to infrastructure, is going to let them down in case that infrastructure fails. Firstly, they are not going to let it fail, because after all, the government can make anything successful. And if they fail to make it successful, they are not going to let the bank fail. So you really had a situation of this kind, which results in a situation in which you have a supply side driven push to expand credit being translated into a substantial increase in credit to a new area, and an important into new areas, and an important new area was, of course, infrastructure. Now, if the current yesterday's Reuters report is right, they are saying that now, even though there's been a decline in the increase in non-performing assets from 5.8% between December and June, from June and December last year, and December and June this year, when it's 4.5%, but 4.5% rate of growth is pretty high, because the base is much higher. And two, they say that now a significant part of it is increasingly in the retail sector as well. So we really are talking about a situation in which the ability of the system to sustain that credit push, which occurred partly driven by the supply side, was actually driving the system to expand the advances to GDP ratio. And you chose these two areas, and those two areas are now turning out to be areas where, because you expanded the universe of borrowers so much, the potential for default has risen. The potential is now being translated into actual results in terms of default. That is generating non-performing assets, and the banks are holding back. They want, what do we do now? What do we do? How do we restructure? Now, if you get into a situation of this kind, obviously, because of the fact that this was a whole environment which was generated because of macro policy. This is, after all, how come the inflow of foreign capital into India went up from a few $100 million to about $8 billion, or from $8 billion to $70 billion? Because of the fact that macroeconomic policy with respect to foreign investment was changed. How come you actually had a change in the ethos in the banking system, including the public banking system? Because you actually wanted to change based on what the Narasimhan Committee reports had said. You wanted to change the way banks functioned, including public banks functioning. So this is part of your larger macro policy. The difficulty with that larger macro policy, of course, is that it includes a component which has become an obsessive fix, not only in this country, but now even more in this country than elsewhere in the world. And the obsessive fix is with the inability or the unwillingness of the state to actually get a fiscal deficit to GDP ratio which is rising, even in a situation where inflation is not so high. So if you're in a situation where the system seems to be slowing down, in any case, you are in a system in which you want to incentivize the private sector, you obviously are not going to go in for increased taxation. If you are not going to be going for increased taxation, plus your macroeconomic liberalization framework says you shouldn't increase the fiscal deficit, then obviously your expenditure cannot grow. In fact, your expenditure must slow down. The rate of growth of expenditure must slow down so that the fiscal deficit to GDP ratio remains the same or falls, goes down to 3%, when your tax GDP ratio is remaining the same or coming down. So therefore, when the banks turned to the government and said, listen, we seem to be in deep trouble. It's pretty difficult once you force us, as the Reserve Bank of India did in 2015 and after, to actually put these stressed assets onto the books as non-performing assets and ask us to provide provision for them. We are ending up with losses. If we follow Basel norms and we have those losses on our books, we are undercapitalized, we would be considered insolvent, and therefore, please recapitalize us. We went through a phase when the government said, oh, we're going to do this. Anyway, small numbers, maybe 20,000 crores, 25,000 crores, whatever it may be. But it's become very clear now that if the government sticks by the other component, other macro component of its reform effort or liberalization, neoliberal reform effort, which is holding the fiscal deficit to GDP ratio down, then it cannot recapitalize the public banking system. So really the problem, the challenge facing the government is, so what do we do? Here we have public banking, and these public banks, of course, are in trouble now. They are in trouble now not because of the fact that, you had a bunch of, speculative bank managers like you had in the United States who went and blew their money in all sorts of toxic assets, but because they were lent to areas in which demand for credit was high, and you were pushing them from the supply side to lend more. You were encouraging them to lend to these areas, and now they are stuck with these non-performing, and we can't recapitalize them. So what do we do? Of course, the simple way out is what I hear occasionally Arun Jaitley takes and says that, oh, your managers did this under the UPA, so why come to us to resolve the problem? As if they didn't do the same thing when the NDA government was in power, as if they went in favor of liberalization, and as if they're not doing it even today. So therefore, that's just a cop-out. That's not what they're actually thinking. So the whole thing now is to discover a strategy to be able to deal with this. And at one point of time, central bank deputy governors and others, finance ministry officials, started going to market and declaring that, well, the easiest way is for these banks to go and sell equity in the market and get money from the market. You put out new equity, go in for, additional public offers, collect money from the market. That's common equity. If it's common equity, it goes into tier 1. If it goes into tier 1, you're recapitalized. That's the way you go. And if at some point of time we have to rethink the 51% or 53% or 60% or whatever it may be we've set in particular cases, we are willing to rethink that. Let's do that as it comes along. But there is space, there is headroom to actually go to market. Now the absurdity of that was that you cannot go to market when you're doing badly. I mean, it's like trying to say we're going to privatize Air India, I mean, who's going to take that, what is it, 40,000 crores? Who's going to take the 40,000 crores of liabilities sitting on the book of Air India when you privatize? You first have to clean the books of Air India, and then Tata's, I'm sure, will buy it. And the Indonesian banking system was in crisis after 1997, and the government decided to take them, to actually to sell them. The only way they could sell them was actually first clean the books and then sell them. So you cannot not recapitalize if you want these banks to go to market. So that seems to be out of question. So then what do? So then the whole idea came up, let's break up these banks, take parts of it, which in some sense is saleable. If there is some assets which can be sold, some segments, maybe some merchant banking business, if they are profitable, I don't know. You take this thing. That's our genius from Stern School, New York. Viral Acharya. He comes and says, this is what we've got to do. We got to break up these banks. Let's dismember these banks and sell what can be sold, and then we'll actually see what's left of this bank, what to do with it. Maybe you have to make some of the creditors take some of the hit. You have to take let the government as shareholder take some of the hit. You have to let depositors who are above the level of deposits, which are insured by the Deposit Insurance Corporation, take a hit. So let everybody take a hit, but let's reduce the amount of hit which is going to come by dismembering these banks. Now, really, this is a very difficult thing to do for the government as government and for a bank as bank. So what you need to do is put it at arm's distance, at arm's length. So the first thing you said is, okay, what we're going to do is say that, listen, these books have to be cleaned. These banks have not been bothered about cleaning their books. Now we're going to force them to clean their books. So first we're going to identify 12 borrowers who are sitting on 25% of our 6 lakh crore at that point of time, non-performing assets. Make an ordinance, put out an ordinance, change the rules, get the Reserve Bank of India to say, you take these people to the National Company Law Tribunal. If you cannot within a certain period of time get a restructuring, put them to liquidation, and if you put them to liquidation, you actually would find yourselves in a situation in which you'd be able to get back a certain amount of money. You're not going to be in a situation where most technical write-offs virtually yield no money whatsoever to most of the public sector banks. Now we know what happened to that. What happened to that is basically they went there, banks were very clear. Their efforts in the past, I mean, you just look at any table, either in the Reserve Bank website or any answer to Parliament question, how much was a result of a technical write-off went as part of a compromise, how much went as a clean write-off, and how much was actually recovered. Recovery was peanuts, because every time you identify an asset, it's so encumbered that you actually cannot take it to market. So therefore, or at least you don't find people who are willing to pick it up in the market. So banks know that if they go the route of liquidation, they are not going to get very much. So the idea was, okay, let's get these, these young chartered accountant geniuses or old chartered accountant geniuses who become these resolution, what do they call them? Whatever, and let them work out some strategy. And we've already seen this through the asset reconstruction corporations. They are sharks. They are waiting for these assets to be sold for peanuts. So the moment you say you're putting a firm through to resolution, then they'll say, okay, we'll buy, but we'll buy at maybe 5 paise to the rupee, 10 paise to the rupee. That's the kind of bids you're talking about. So obviously banks realize that forget actually trying to liquidate. Even if we try to go through the resolution path, this is not yielding very much. It's better for us to write off and try and get as much as we can out of these people, and keep it in our books and write off and take the loss. So therefore, when the Reserve Bank of India said 12 is not enough, we don't even know the final number, 26 more some say, 30 more some say, 40 more some say, by the end of this year, by December 31st, you should resolve all of these. Banks are now, there's a report in today's paper, banks are saying, listen, we don't want to do this, we want to go and tell the Reserve Bank of India, we don't want to do this. So we prefer to actually find ways of resolving the problems ourselves, maybe carry it in our books, help us recapitalize, okay. Now, the whole point is, earlier the focus was through the bankruptcy code, the insolvency and bankruptcy code. When they realized that this is not enough to push the banks, using that change, they decided to have the current, the act which has now been put in, which is basically to say that you can force a bank to go down the route of restructuring that you think it should go. Should it merge? Should it amalgamate? Should it take a bail-in? Who should take a hit? All of this will be decided by an independent regulator, or whatever you call him, not regulator, resolution authority, your resolution corporation, whatever it is, and you force the banks to do this, okay? Now, the whole point is, if you're actually going to do this, you're going to get into a situation where every stakeholder and every constituent is going to get hit. And of course, in some cases, it's going to be constituents outside. Look at the case of Jayaprakash Associates and Unitech. They didn't even think about the fact that they were home buyers who had paid huge amounts in advance, hadn't got their home, and because they weren't secured creditors, they were not going to get anything, And obviously, this is a problem. They went to court themselves. They had to go to court themselves as residents. So it's a completely unthought out way of trying to resolve the problem. Now, so therefore, as far as I can see, there is a government desperate to somehow get rid of this problem and is willing to go anywhere so long as there isn't major opposition. Now, the problem is it's not going to be easy for them not to face opposition, and the opposition is not only going to come from bank employees and bank officers worried what this restructuring is going to be. It's not going to be, just look at Tata Teleservices, Let us not forget that Tata Teleservices took a huge amount of the surplus, which is cash surplus, which was sitting in the books of VSNL, where on the basis of a 26% purchase as part of a strategic sale, and then of course going to market because of SEBI regulations, Tata picks up VSNL and just takes this huge quantity of money and invests it in Tata Teleservices. People have forgotten. Now what is Tata Teleservices saying? We're going to throw out 5,000 people, because of the fact that, unfortunately we're making losses. This is bad business. So you basically want to find some way, and it's going to be difficult for them to deal with the opposition. Now what is the larger message? Is the message that the banks did something fundamentally wrong? And I'm sorry, I think I've taken a little long, but I'll just take another 3-4 minutes. That just think of, supposing we go to Germany. Germany was a country in which we know that prior to the Second World War and after the Second World War, it had a banking system, the credit banking, which actually did all the things which a typical Anglo-Saxon commercial bank was not supposed to do. It invested hugely in railroads, in dams, in cities, in things which normally a commercial bank was not considered, it was not considered proper for it to do because there were huge liquidity and maturity mismatches. It undertook these things, but it not merely provided huge amounts of credit, it invested in the equity of these companies, which is supposed to be a conflict of interest for a bank to own equity and lend, because then you'll never want your money back because you'll want the firm to keep surviving. You decided to take these firms to market, use the reputation of the bank to attract capital as investment into these companies. There was a complete nexus. And, people were saying, so what happened? I mean, this worked, it actually helped them generate the Industrial Revolution. It helped them, along with the Marshall Plan, recover from the complete devastation of Second World War. And if you read, even in the 1970s and in early 80s, reports coming in from England and the United States, they'd say part of the reason we are not successful and Germany and Japan is because they have a banking system which is completely different. It does precisely the set of things which banks in England and banks in America, till of course the 1980s and 90s, were not allowed to do. Glass-Steagall did not allow American banks to do this kind of thing. So they said that we should be doing that kind of thing. So the point is, it is not at all true that a model of commercial banking has to be a model in which a commercial bank does not lend to big projects, does not play also the role of a development bank. But the question is, how come this maturity and liquidity mismatch didn't result in a crisis in Germany? How come till the Plaza Accord, when America forced Japan to appreciate the yen hugely vis-a-vis the dollar through a sort of engineered intervention, that Japan was so hugely successful when its banks were doing precisely this, lending large amounts of money, the so-called city banks, through the main bank system, to the large zaibatsu, financing their whole, foray into the export market, the export-led success. So it's not that you don't do these things. You lend to industry, you lend to capital-intensive industry, you lend to infrastructure. This has happened and quite successfully. Other things explain the failure. So therefore, the issue is, okay, how did they manage that kind of thing? And one thing, there's this famous economist, Piero Sraffa, an Italian economist who then went on to Cambridge, who's famous actually for a completely different book called Production of Commodities by Means of Commodities, which is considered, one of the top seminal works of 20th century economics. But Sraffa had given a set of lectures in continental banking. And he said the thing about continental banking is it's so fundamentally different from Anglo-Saxon banking, because what you have is you have this nexus between banks and industry, where banks do all this as well as have people on the boards of directors and are involved in decision making. But these banks, even though they are open to liquidity and maturity mismatches, don't face this problem, because unlike under the Bank Act in England, the central bank in the Reichsbank, the central bank in Germany, uses the right of note issue to ensure that every time the banking system runs into liquidity difficulties, they will pump liquidity into the banks so long as the bank was following this kind of a policy. So Sraffa's argument was that this is a model of public banking within a market economy. Not public, private, of banking within a market economy, in which it was almost like you're running a planned system, sitting at the apex of which was the central bank, operating its allocational requirements set by the state through the banking system, and where the banking system, in collaboration with industry, is involved in implementing this larger allocation of resources, and that allocation went precisely the way you wanted it to. So you're essentially saying, if a government says that, listen, I'm going to close down development banks, I don't have a successful bond market. Everybody's saying, now that banks can't lend, corporates are turning to the bond market. Peanuts. It's not that much money that they're getting out of the bond market. The corporate bond market, so there's some speculative investment by foreign investors, but it's not going to, actually replace. So if a government says that the only way I can finance capital intensive investment, because of the fact that whether you want to make in India to export or make in India to sell in India, you need large scale investment, and I don't have a development banking segment, in which case I have to get the banks to do this. And if I have to get the banks to do this, obviously I must be able to ensure that these banks have liquidity. I must be able to use the fisc to recapitalize them when they go wrong. I must find ways of trying to ensure that they don't go wrong. And if circumstances make it difficult for them, I must ensure that the central bank uses its right to issue currency to create the liquidity needed to protect these banks. Now, that's the only way you can resolve this problem. You can't have a system in which you need the banks to do certain things and somehow says it's the problem of the banks. It's not the problem of the banks. It's the problem of capitalism. Capitalism has to use its banking system in a particular way, and if it is going to do that within a framework of whether it be private banking or public banking, it has to do it in a way in which it has the mandate of the state and the protection of the state in order for it to be able to implement what is a process of actually undertaking this kind of growth. So really, as far as one can see, there are two levels. The challenge is at two levels. Firstly, you cannot have a neoliberal framework in which you can have successful banking anymore, even if it is publicly owned. And secondly, you not merely need to move away from a neoliberal framework, but you need a complete change in perception, because you're not first industrializer England, you're not a frontier economy like the United States, you're like, much later of course, you're like Germany was, you're like Japan was, you're like South Korea was, and all of them did this. And you need to do it, not because of the fact that you believe in socialism or public ownership or anything of the sort, but because of the fact that otherwise capitalism doesn't have a way of running a successful banking system. And I think coming to terms with the challenge to challenge neoliberal economics, which of course is very difficult, but crises tend to make changes, and coming to terms with the need to be able to create an environment where failure to do what they're trying to do, which is staring them in the face and they're not willing to recognize it, actually leads up to a situation where we say that, listen, forget about socialism, forget about all that. If you want a successful banking system within a working market economy, this is the only option that you have. The state and the central bank must back commercial banking in this country.